Another situation where we'll need the general journal is to record a bad debt. So a lot of businesses offer to sell goods on credit, and we've dealt with that before as a transaction. So Harvey Norman's a very famous example. So in this case, customers would get 22 months interest free with no deposit, no interest or no repayment. So that's a credit sale. Now the risk with that is that there's always a chance that the debtor won't pay. So you can see here's an article about Harvey Norman saying that they've had to hire debt collectors. So that'd be something you'd do if you couldn't get a debtor to pay. So when debtors don't pay, we're going to write them off and call them a bad debt. So what does that actually mean? It's defined as an amount owed by a debtor that is written off as an expense because it's deemed as being irrecoverable. The business will never be able to get it. And it does mean that either we're not going to get any of it, or maybe we'll just get some of it. So why is that an expense? We're looking at our definition. It's either an outflow or reduction in inflows. It's going to decrease assets or make liabilities go up and ultimately decrease owner's equity. So just looking at why this is an expense, let's take the situation on the left. The debtor owed $200 and they're only going to pay us $50 back, and the remainder will be a bad debt. Let's assume the debtor was going to pay the whole amount back. So the inflows of economic benefits would actually be $200. But what if the debtor only could pay us $50 and write the rest off as a bad debt? Well, the inflows of economic benefits there are only going to be $50. So you can see there's a much less cash being received by the business. So when we receive less cash, that's basically called a reduction in inflows of economic benefits, and that makes it an expense. So how we record this is we'd say we've got more money, so cash at bank's going up, which is a debit. We've recorded an expense called bad debts, which is a debit. And lastly, our debtors control account will go down. It'll go down by two amounts: the amount of cash we receive, which is $50, and the bad debt amount of $150. So you can see those entries match up. We've got two debits with two credits, and the references are accordingly matched up. Looking at why it's an expense, it's because we've got a reduction in inflows. This isn't an outflow of economic benefits. We're actually getting money. So this is an expense because there's a reduction in inflow. What is the reduction of? We're getting less cash than we would have if the debtor paid us back in full. Is an asset going to go down? It is. In this case, it'll be debtor's control. So it won't be cash, it'll be debtor's control. And lastly, that'll decrease owner's equity. Comparing that to a wages expense, that's a quite common and straightforward expense. That's an outflow of what? Cash usually. Decreases assets, the cash asset, and decreases owner's equity. But bad debts is a little different. Instead of an outflow, it's what we say is a reduction in inflows in the form of less or maybe even zero cash coming in. And the asset that goes down is not cash. Cash will actually go up. In this case, it's debtor's control that decreases. Ultimately, the effect is that owner's equity goes down. Looking at how we record that, let's say total debtors owed us $15,400. Well, that'll go in our general ledger, like so, in the debtors control account. On March the 9th, we made a credit sale to T. Simmons for $200 plus GST on 30-day terms. So in T. Simmons' subsidiary ledger, we do a debit there on the 9th of March for $220. 6 months go by and we're advised that T. Simmons has been declared bankrupt and won't repay any of their account. So that's a bad debt, but we don't expect to recover the amount. So what we'll do is record a bad debt expense of $220. That'll reduce debtor's control. Debtors will go down because he's not going to pay us back, but we'll write off his amount. And what we need to do is make an entry in the subsidiary ledger there to reduce T. Simmons' account. Make a narration, debtor T. Simmons written off as a bad debt. So mention the name of the debtor in your narration and put your memo number. How are we going to post this? Well, we're going to need to do entries in the general ledger and in the subsidiary ledger. So in the general ledger, we've got a debit to bad debts, which is going to be an expense going up. We've got an asset going down called debtor's control. So when assets go down, that's a credit. So debtors are going to go down because we're writing off this debt. And lastly, we'll need to go to the subsidiary ledger and make a credit into T. Simmons' ledger like so. Entered on the actual day of the transaction in the general journal. The last day of the period in the general ledger and subsidiary ledger is always the actual day. Let's deal with a slightly different situation. Let's say T. Simmons did owe us $220 exactly like before. He's been declared bankrupt again. Just one slight difference. He's going to pay us 30 cents in the dollar rather than nothing. We're going to get some of it, and therefore we'll just write off the other 70% as a bad debt. So the total amount owed is $220. So what's happening here is we're going to get 30% of that. That's called 30 cents in the dollar. So 30% of 220 is $66. Well, that'll go on our cash receipts journal because the business is receiving money. But it's the other part, the bad debt part of 154. Because that doesn't fit in any other journal, that's going to have to go on our general journal. So looking at that, let's deal with the $66 of cash received. So we go to the cash receipts journal, we do the date, the details, the name of the debtor, and the receipt number. We put $66 in the bank column, nothing in discount, and debtors control goes down by 66. Dealing with the bad debt part of 154, that'll go in our general journal. We had a debit to bad debts of 154, a credit to debtors control of 154, and we'll update his T. Simmons's subsidiary ledger in the final column there. Do a narration, same detailed narration as before, with the memo number. Looking at the posting, so we've got $66 going in the bank. From the cash receipts journal, we've got debtors control will be going down $66, so that'll be a credit. So we've posted the cash receipts journal. We've now got the general journal, and we'll also need to take $66 out of T. Simmons's ledger. What we're going to do now is post the general journal. So we'll take the bad debts expense, which is a debit, going up, and then we've got the credit of 154 to debtors control going down in the control account. In the subsidiary ledger, we've got T. Simmons's account going down 154, and that'll write off his ledger completely. He did owe us 220, we've got 66 back, and we're writing off 154 as a bad debt, so his ledger will balance out to 0. We might get some theory questions about what are some strategies you can use to reduce bad debts. So we want to talk about things like, why don't we run credit checks on customers before we even make a credit sale? Check that they don't have a history of leaving their debts and not paying them. So we want to run some credit checks. We could offer discounts for prompt payment. Someone's probably more likely to pay a debt if they know they're going to get a discount, so that might reduce bad debts. We could charge interest on any overdue accounts, but only if the original contract says that. If someone just doesn't pay us back and we're not happy, we can't charge interest because we want to. We're going to need to make sure it's in the original contract. We could send monthly reminders or phone calls or emails encouraging people to pay. We could send out a monthly statement, kind of like the bank does with credit cards. Or we could employ some debt collectors. So we saw Harvey Norman with the article, you actually hire a company to go and get your debts. Lastly, maybe we just take legal action, and we do have a legal right to the money, so we take them to court to try and get it.